Right, quick agenda. We're going to do the usual news updates, hot news topics, and then before we move into the main sections, which is going to be on the newly named IHT Business Relief, and then we'll run on to our part two of the second part of our pensions update, the first one being from February, and in Q&As at the end. Next slide. Right, speakers today. Hopefully, most of you, certainly those who use the tax line, should know most of us. Jeff, Sadiq, and myself. I'm Chris Holmes, if you didn't know. We're all sort of the main consultants on the tax line. So if you phone up, you'll like to have spoken to us. Rob is one of the VAT team. So if you've ever had a VAT question, the odds are it was answered by Rob, because I know he picks up the majority of them. Christy is also in our team, who support us on everything to do with IHT, trust and probate. So a lot of you may have spoken to Christy previously before. So that's who we are. Next slide, please. Oh, okay, before that, before I go straight into Jeff's, I just want to say that if you've got any questions on the way in, please do drop them into the Q&A box and we will answer them at the end of each section. But it's easier to, if you think about the start, if you put them straight in. Right, okay, I will move over first to Jeff and then to Rob on the quick news. Thanks.
Hi, I'm Jeff Webber and I'm covering the direct taxes news items today. We've got 5 topics that we think are of particular interest. And we're starting with a look at recent Court of Appeal decisions on IR35. The Court of Appeal recently published its decisions on 2 more IR35 cases, namely Kickabout Productions Limited and Athol House Productions Limited. These are cases where there have been disputes with HMRC about whether IR35 did or didn't apply. And these appeals have come up through the first tier and the upper tribunals and have now reached the Court of Appeal. The first one is Kickabout Productions Limited. This case involved the TalkSport radio presenter Paul Hawksby, and the Court of Appeal upheld the upper tribunal's decision in favour of HMRC. The Court of Appeal agreed with the upper tribunal that there was indeed mutuality of obligation, which is an important pointer to the existence of the hypothetical contract of employment. Now, this is an interesting point in that HMRC over the years have tried to disregard mutuality of obligation as an important factor. But I think they've come to see that it's an absolutely basic factor when trying to establish whether there is a hypothetical contract of employment, because without mutuality of obligation, there cannot be an employment. In addition, the Court of Appeal decided that the upper tribunal had correctly ruled that TalkSport sufficiently controlled the where and the when Mr. Hawksby performed his duties, and also the what regarding the tasks that Mr. Hawksby performed. And the conclusion that they reached was that the upper tribunal was correct in deciding that IR35 did apply to Mr. Hawksby. The second recent case is Athol House Productions Limited. This case involved the BBC presenter Kay Adams, and the Court of Appeal accepted HMRC's argument that there were hypothetical contracts of employment, again, due to the existence of mutuality of obligation and the right of control by the TV company, the BBC, although, interestingly, the court mentioned that regard should be given to a broader range of factors, including whether the individual was in business on his or her own account. Despite that, they felt that there were insufficient other engagements, and the reality was that Kay Adams, or rather her company, if we look at a hypothetical contract of employment, would have been an employee of the BBC. I think the takeaway from this is that these types of cases will come before the tribunals and courts probably less often in future, and that's due to the recently introduced off-payroll working rules, originally for public but now also private sector organisations, as a result of which broadcasting and other organisations have moved to place more individuals on contracts of employment and take the hit on PAYE and NIC. I don't think we're at the end of this line of cases. They seem to be coming up every month, and there's probably some way to go, but we think that they will ease down in future. The next topic I'm looking at is the statutory residence test, SRT. Existing guidance in the Revenues Manual stated that while the exceptional circumstances exemption would generally not apply in respect of events that brought an individual back to the UK, where the Foreign and Commonwealth Office advised avoiding all travel to a region, individuals who returned to the UK while the advice remained at that warning level would normally have days spent in the UK ignored under the SRT, but subject to the minimum 60-day limit. Now, in line with this approach, HMRC have recently amended their guidance, confirming that as the current Foreign and Commonwealth advice is against all travel to Russia, Belarus and Ukraine, individuals returning to the UK from those territories will qualify for days spent in the UK to be disregarded due to exceptional circumstances, again subject to the 60-day limit. And HMRC says that it will also take into consideration any wider reasons outside the individual's control and look at the facts and circumstances of the situation. So if you have any clients who were based in Russia, Belarus or Ukraine, the Revenues Revised guidance will be helpful. Moving on now to a recent EIS case where the First Tier Tribunal looked at whether the Revenue were correct in denying the issue of EIS certificates to a small film production company. The case was Inferno Films, the HMRC, where the First Tier Tribunal held that EIS relief should not be denied solely because the investing company had focused on activities. Incidentally, there was no suggestion that this was a tax avoidance film company. It was a straightforward trade. The background is Inferno had acquired the rights to the Spectra film and subcontracted production to another company called Sterling. And this is a purely commercial decision. And the tribunal found that Sterling had wished to work with Inferno because of Inferno's desire to develop further films. Inferno had sought EIS investment, and the investment memorandum had focused on the particular film, but also mentioned an intention to develop further films with a list of potential projects. HMRC had taken a very
Jeff, sorry to interrupt, but your sound's a bit funny. Can you?
I'm sorry. I'll speak a bit louder.
Yeah, thanks.
Yeah. HMRC had refused EIS certificates on the basis that Inferno had not met the risk to capital condition, requiring the company to have an objective to grow and develop, or significant risk of loss of capital for the investors. The tribunal thankfully allowed Inferno's appeal. They found that HMRC was interpreting the statutory requirements too rigidly. New businesses such as film production may naturally start operations on a project-by-project basis until able to increase their activities. The tribunal also found that the investors risked losing their entire investment because filmmaking is a risky business. Additionally, Inferno's objective had been to grow and develop its trade, and of course a company could trade through subcontracting. So this decision is also a reminder of the need for EIS companies to be able to demonstrate genuine growth intentions from inception. This should be mentioned in the investment memorandum, and ideally they should have a business plan. Just to finish, I'm going to cover one or 2 points on tips and troncs and transparency of property ownership. With regard to tips and troncs, last year, legislation had been announced by the government under which there would be an employment for all employers in the hospitality business to pass on all tips to hospitality workers without any deductions. And if an employer broke the rules, they could be taken to an employment tribunal and face fines and penalties. Unfortunately, there has been no mention of this proposed legislation in the recent Queen's speech, so it does look as though it may be deferred and is unlikely to kick in from April 2023. So we shall have to see what the government decides to do on this. And finally, I'm just mentioning the increasing transparency of land and property ownership. The Levelling Up and Regeneration Bill, recently introduced to Parliament, once enacted, will enable statutory instruments to be issued to require information about beneficial ownership of land and property to be given to the land registry and recorded there. This complements the Economic Crime (Transparency and Enforcement Act 2022, which was enacted earlier this year, which requires owners of offshore entities which own UK land to declare the beneficial owners to Companies House. This is aimed obviously at the Russian oligarchs, but in fact will catch a far wider range of owners. And that, Chris, that finishes the direct tax news updates. So next slide, please.
Okay, well, good afternoon, everybody. I'm Rob Edwards. I think I've spoken to some of you. At least we've done a quick look at the attendees list with VAT queries. So you're now into the most exciting part of the webinar, which is what VAT or indirect tax and VAT customs duty. And yeah, so the first one I want to talk about is you may have heard in the press that Jacob Rees-Mogg, the Minister for Brexit Opportunities and Government Efficiency, apart from other things, is announced in the House of Commons that the certain Brexit easements that were supposed to be withdrawn from the 1st of July this year are now not going to be withdrawn until at least the 31st of December 2023. And this is to do with the certification and physical checks of certain goods that are classed as needing safety and security declarations. Now, this only applies to goods coming from the EU. Goods from outside the EU, this has always been the case, it's never changed. And exports of goods as well you had to make these declarations from the 1st of October last year. But the basically for things like sanitary products, animals, plants, plant products, dairy products, these you would have to make a declaration so that HMRC and Customs can assess the risk of certain goods coming into the UK. Now, this has been postponed for at least 18 months. The reason being, well, the cost of living crisis at the moment, the inflation crisis, the war in the Ukraine has come into it as well. And basically what they're not wanting to do is to pass on the cost of these additional checks to customers. Now, some businesses have been prepared for this already and got geared up, and I know the ports are not too happy, having got all their systems in place ready to do these checks before they let goods through. But the main message is still, even though it's now deferred for another 18 months, if you have clients that are importing goods that are covered, that require safety and security checks or declarations, then make sure they are still getting ready, because 18 months will pass quite quickly. And obviously the main thing there as well is at least the 31st of December 2023. It could go beyond that. We haven't been told anything different than that, so that's what we're still working to at the moment. The second thing is to do the DIY house builder scheme. I'm not sure how many of you have dealt with these claims before. Those of you who have, well done, because they are quite a time-consuming thing to put together. But just as a quick reminder what the scheme is, this allows people who build their own houses to basically recover VAT on the materials that they buy. And if they are converting commercial buildings into residential, so for instance, a barn conversion, they can also get back the services from the builders, the VAT back on the services from the builders. So quick reminders to qualify: it's got to be self-contained living accommodation, so it's got to have planning permission. The separate use of disposal can't be restricted, and there's no direct internal access to other dwellings, and it's got to be for your own use. Okay, so it's your own use or own holiday use. So you can actually go and go and find a nice patch of land in, say, North Wales, and build your own holiday home. And the key thing is it can't be for business use. And once you've built it, you collect all your invoices together with the building plans, the planning permission, and the important thing, the completion certificate from building control, and submit it as a claim to HMRC. And it has to be submitted within 3 months of completion. Now, the business brief that HMRC released 2 weeks ago was regarding the first tier tribunal case of Andrew Ellis and Jane Bromley. Those who remember Mark Ellis, I don't think there's any relation to him. But they submitted 2 DIY claims to HMRC. The first one was based on what they thought was the completion certificate. It was actually the council tax valuation certificate. And then once they realised this and had been granted planning permission for some further work to the same property, they submitted a second claim. Now, HMRC's policy has always been that you have one opportunity and that's it. You make one claim, and if you miss that, it's tough. So they paid the first claim, no problem, went through, and then the second claim they rejected on the basis that it was outside the 3-month time limit of completion. The first tier tribunal ruled that HMRC were in error for paying the first claim because the building wasn't completed and they hadn't got a completion certificate. And the second one was actually within the 3-month time limit from completion. Now, there was an interesting discussion in the case as what is a claim for these purposes, because the law doesn't say it is one claim, it's just HMRC's policy. And actually the judge in the case said, actually, multiple claims should be allowed. It's not surprised HMRC haven't really appealed to the upper tribunal on this. They set up this business brief saying this is what our policy is. But the purpose of this brief is just to actually remind people, one, that you have got 3 months from the completion to get your claims in. But if HMRC actually pay out a claim in error, then you can then actually submit a second claim if there's errors. So, for instance, if you missed invoices off that you have come in late, or you just forgot about them, for instance. Now, HMRC haven't said anything about changing their policy on accepting multiple claims, and maybe this is another case. This is a discussion for another case in the future. But just a useful reminder that, one, the scheme is still there. Two, if you want assistance, we can assist with these claims, obviously for a fee. And three, remembering the key requirements, it's got to be submitted within 3 months of completion. And if there are errors, HMRC will now accept a second claim if there are genuine mistakes. And the third thing I just want to talk about is the revised late submission penalties. Now, you may remember that this was supposed to come in for periods starting on or after the 1st of April 2022, and this has now been pushed back to the first period starting on or after the 1st of January 2023. Now, you remember the current system at the moment, your first late submission or late payment, you get a default surcharge notice to tell you that you've been naughty. And that for 12 months, if you submit anything late again in the 12 months or make a payment late in the next 12 months, then you'll be subject to a financial penalty. And obviously, then if you are then late in that 12-month period, you then get a 2% penalty for the first offence, second offence is 5%, third 10%, third 15%, and so on. And the surcharge notice period is then extended by 3 months for each offence. The new system is going to be completely different, and the new system will be a points-based system. So rather than points meaning prizes, points will mean penalties. And what will happen is if a business is late submitting the return or making a payment, they will then get a point against their record. Now, when a certain number of points is reached, you'll then get a £200 penalty. So the number of points threshold for this £200 penalty depends on how many on your VAT filing. So if you're on annual VAT filing, you get two points, and that's it. You then get a £200 penalty. If you're on quarterly VAT filing, it's 4 points. And if you're on monthly returns, it's 5 points. So once you reach, so say you're on quarterly returns, you for a whole year, you submit a whole year's worth of returns late, you'll then get £200 penalty. Now, the important thing as well here is that the points only have a lifetime of 2 years. So it's a bit like your points on your driving license almost. You know, they do have an expiry period. And also, all points will be wiped out if you are compliant for a certain period of time and all returns in the previous 24 months have been submitted on time, regardless of whether, regardless of whether or not they're late. So the compliance periods HMRC set out is that if you're on annual returns, you've got to be compliant for 24 months, i.e. you've got to submit 2 returns on time. You've got to submit 2 returns on time and make the payments for those returns on time. If you're on quarterly, it's a 12-month period. So that's 4 returns you've got to submit on time and the payments made on time as well. And if you're on monthly returns, it's 6 months. So you have 6 returns you've got to submit on time and make the payments on time. Now, the main issue at the moment is that HMRC haven't yet disclosed as to how this interacts with the existing system. So let me give you an example. Say you have a client, they submit the VAT return late for the 30th of September. They submit it late, say on the 12th of October, sorry, 12th of November even, so I get the dates right. And they get a default surcharge notice. Now, in theory, that notice will run for 12 months until the 30th of September 2023. However, by that point, the new system is in place. So will they automatically gain points because they were late, because they're on a default surcharge notice? We don't know at the moment, so that's something we have to clarify later on. But the main message from this is that the system is changing. And in theory, it takes longer to obtain the financial penalty. But, and this is the big but, is that now, even for refund returns, you will get a penalty if it's late. If you obviously if you go over the point threshold, you'll get a penalty if it's late. Whereas before, the 2, 5, 10, 15% was based upon the VAT due on the VAT return. Obviously, HMRC don't pay you back that if you're on a refund return if you're late. So that's the key thing to notice, that if you have a client that is on regular refund returns or repayment returns, they can still now get penalties under the new system. That's it for indirect tax news. Next slide.
Thank you very much, Rob. And it's definitely the most interesting part of the lecture. No questions have come in. We don't normally from Hot Topics, so if you have any questions, put them on there, but I suggest we just move straight on. I say Christy is a part of our IHT Trust and Probate team who support TSP clients since Jackie retired. So I will hand over to Christy, who's going to give us the I'm not sure much has changed other than the property. You may have noticed property has dropped out of the name. It's no longer business PPR, but Kirsty's going to deal with all of, Christy's going to deal with all of that. So I will pass you over.
Hello, everyone. I did want to say that the biggest change, as far as I'm concerned, is the fact that it is now business relief, not business property relief. And I'm personally still getting used to that. So I do apologize if I accidentally say business property relief at any point in time. I mean business relief at this point. I will go through just briefly what the business relief is, what the rules are, what are the pitfalls around accepted assets, and then mention a few planning ideas that we've seen that can be used in relation to business relief to assist your clients. If I could have the next slide, please. So this probably isn't news to you because, like I said, they've changed the name. They haven't really changed the rules around it. I'm mainly focusing on shares held in an unquoted company here. I'm sure you all know that inheritance tax reliefs are also available for unquoted businesses. But to narrow it down a little bit so I don't go on all day, I'll focus on shares. If you have any questions about other types of business, let me know. The company would need to be wholly or mainly trading either a company or the holding company of a wholly or mainly trading group. Wholly or mainly means more than 50%. So 51% trading, 49% investment would, in theory, qualify. The owner needs to have held the shares for at least 2 years, and the business cannot be prohibited activities. So dealing in security stocks and shares, dealing in land and buildings, making and holding investments. There's obviously a gray area here, especially in the lands and buildings bit. So if you do have a client in that area, then it's worth looking carefully which side of the line they actually fall. One important point to remember is that the conditions are only tested at the time of chargeable event. So worst case scenario, a client has a trading company for all their life, but it gathers cash, and at the point of death, it turns out that it's now mostly investment rather than trading. It doesn't matter that the previous 30, 40 years, there would have been trading company. At the point of the client's death, it's an investment company and therefore no relief is due. Next slide, please. One thing to bear in mind, rather than just 51% trading, is also if you have non-trading assets in there, what are they? Because accepted assets get excluded even if the company is mostly trading. What are accepted assets? Well, they're assets that are not needed for the current or future use in the business, which is sometimes fairly difficult to decide. So there is quite a lot of case law and quite a lot of analysis around, and obviously the circumstances of each case are very, very important. The most common example that we see is significant cash balance. And the main question to ask there, is it access to requirements? It might well be that the company has several million of cash on the balance sheet, but they're planning an expansion project on their trade. They're keeping it to cover stock fluctuations, and therefore can be argued to be for the purposes of trade. The way the restriction works is not that it means the whole company doesn't qualify for relief. It just exempts part of the value of the company from relief. So if 10% of the company's value is considered an accepted asset, then that means 10% of the company's value broadly is not subject to the relief, and you will have an inheritance tax liability if a transfer takes place. So what can be done to mitigate this situation? Obviously, making sure, if we're dealing with a cash balance here, making sure that the cash balance is used for a business activity. Note that it does say business here, not trade. So ideally, you'd use the cash in the trade, but it's possible even to invest it into, for example, a stocks and shares portfolio within the trading company. As long as the stocks and shares portfolio isn't more than 50% of the total company, then that means it would still be covered because it's needed for the purposes of the business. And as long as more than 51% of the total business is trading business, the remaining 49% is still covered by the business relief. There's also an option to restructure where there's a holding company and subsidiary structure, and some subsidiaries may be mainly investment, others mainly trading. It may be possible to move the assets around to make sure that all companies are mainly trading. It does depend on values, and it's quite a complex exercise if the company structure is quite big. As it does mention here below, the common thing that we see where it's an investment asset potentially not eligible for business relief is property that is let out. There is an exemption to that is if the property is let out to fellow subsidiaries who are using it in their trade. In that case, it doesn't qualify as an investment asset. It would still be a trading asset, even though it's in another group company. Next slide, please. So this slide deals with the loss of business relief and what you can do about it to plan for it. So one thing that definitely can happen, like I mentioned before, is the proportion of the trade is declining and the proportion of the investment activities is increasing. If you spot that in one of the clients and there is a desire to do something about it, it is worth doing something before the business relief is gone. So while it's still 51% trading or more. What you can do is settle the shares into trust beforehand. If business relief applies at the point of settlement, like we said, it only relates to, it's a snapshot assessment. When it goes into the trust, business relief applies, and that's it. Even if the settlor happens to die within 7 years of making that particular gift, as long as the trust continues to hold the shares, the same shares, whether they qualify or not, the gift to the trust is not going to be recalculated. The business relief will still apply. So if there's a danger of losing the business relief position, it might be an idea to do this, or at least discuss it with your clients. There's also the option of demerging non-trading activities to retain the trading activity at least on part of the value that we're talking about. What can also happen, obviously, is the company becoming fully listed. Again, in that case, settling the shares into trust ahead of listing will mean, as mentioned before, that while the shares are in the trust, they will still notionally retain the business relief. It is worth bearing in mind the rule around binding contract for sale. When does listing become a binding rule? So it can happen a lot sooner than if you just sell the shares. So the dates are quite important if you are planning around listing. The other option is selling those shares ahead of the full listing and reinvest the funds into new business relief qualifying assets. I will actually, next slide, we'll discuss replacement business property. So I will go into that bit a little bit further. And finally, and probably one of the more common ones that we see is the sale of shares. So a business owner has held a business relief qualifying asset for the whole of their life, but decide to sell it for a large amount of money. That amount of money will not qualify for business relief the date the contract becomes unconditional. So what can be done? Obviously, settling shares into trust pre-sale. Business relief applies. When the shares are sold, the cash will go into the trust. The trouble is, in this instance, because the trust will not be owning the same shares anymore, then the cash is subject to the 10-yearly charges unless it is reinvested into business relief qualifying assets. The other option that can be considered is selling at subsidiary level. So when the shares are settled, sale is at subsidiary level, the holding company will be holding all the cash. And if those shares are not disposed of by the trust, in theory, the business relief will still remain available even if the settlor doesn't survive the full 7 years. Next slide, please. As I said, talking a little bit about replacement business property. So where one asset qualifying for business relief has been disposed of and the owner would like the business relief to apply to new assets. So as it says here, original and replacement assets must have been held for 2 out of the last 5 years of when you're actually considering the chargeable event. There is a little footnote here that where the business relief qualifying assets inherited from spouse or civil partner, so not inherited from anyone, just spouse, civil partner, on their death, the ownership period is grandfathered. So where a husband has a business relief qualifying asset that is inherited on his death by his wife, who then sells it and reinvests into other business relief qualifying assets, that is where the grandfathering takes place. There's 2 slightly different ways the replacement assets work. One, if the person who disposed of a formerly qualifying property is trying to recreate it in their own hands. That means they don't need to invest all of the net proceeds, although obviously only the amount of net proceeds they do invest will reacquire the business relief cover. The replacement asset can itself be replaced, so it doesn't need to be the one asset that will be kept forever. This is where the use of the AIM portfolios comes in quite often. Financial advisors propose that people buy into AIM portfolios and create a business relief covered proportion of assets, and those portfolios are usually actively managed. So there are purchases and sales, but it is fine. That's not a problem. If there is a sale and a following purchase, in the in-between time, the net proceeds must be held as cash. They can't be invested into another non-business relief qualifying asset in between. That would break the link between the two potentially qualifying proportions. A bit more complex situation arises where the business relief covered asset is gifted into a trust or gifted to another individual, and the trust or the individual has not itself held it for 2 years and then sells it. So this happens quite often with a pre-sale trust where a trading company shares are gifted into trust pre-sale, but then sold shortly after, and there is a lot of cash in the trust and the 10-year anniversary is in consideration. In that case, whole of the net proceeds and net of costs must be reinvested. Once you have reinvested it, the asset cannot then be replaced by yet another one. So in this instance, the AIM portfolio would not be a good idea because the assets usually get replaced at the fairly regular intervals because it's a big portfolio. And again, if there is a gap between selling the one asset and buying another one, they need to be held in cash. They cannot be held in any other assets. A fairly niche area, but even if the transferor dies shortly after settling the shares, as long as the reinvestment happens within 3 years of disposal of the original asset, i.e. the 2 out of 5 years, it is still possible to get business relief. Next slide, please. So a usual thing that comes up is I've got the trading company and I've got a big cash balance in my personal name. Is there any way I can relieve or make the inheritance tax situation on this cash balance a little bit better? Now, if the company needs money, it is possible to add the funds to the company in exchange for shares. The company will use the cash for the purposes of its trade or business, and additional business relief is available on the cash that was previously not covered. What you need to be considering is that if new shares are acquired, usually you need to be holding them for 2 years. So the 2-year minimum holding period for business relief is very, very important. However, if it's structured as a rights issue, so new shares are issued for cash consideration in proportion to existing shares as part of a rights issue acquisition, then the holding period with the original shares is grandfathered to the new shares. So that might help you in covering the additional cash that the company needs with business relief from the start. Obviously, if we're not talking cash, it's a little bit more complicated. So you also need to consider capital gains tax, stamp duty, land tax implications if you are transferring non-cash assets into the company. And you may have noticed I was stressing the cash needs to be needs to be required for the company's trade or at least business. because the company still needs to A, remain 51% trading, and B, cannot be holding accepted assets. So if the cash is surplus to requirements, it will not help in acquiring additional business relief for the company. Okay, and one final slide, if I could have the next one, please. Another thing where business relief is quite often used is in will planning. So this obviously needs lawyers to be involved as well, because the will needs to be quite carefully drafted, but broadly the idea works where business relief covered assets are left into a discretionary trust, and anything that isn't covered by business relief, meaning it would be inherently chargeable to inheritance tax, would be left to the spouse, either the spouse directly or, more common, leaving it into a life interest trust for the spouse. And what can then be done is swap the assets for the amounts need to be equal value. There can't be any value being transferred from one trust to another, but for equal value, the assets in the two trusts or two parts of trust are swapped, so that the spouse will now acquire the assets that potentially qualify for business relief, and the discretionary trust will have the non-business relief assets. Now, obviously, the spouses acquired brand new assets, which they didn't inherit on death, and therefore they need to hold it themselves to get business relief cover after 2 years. As you can see, we're calling it double tip planning, as essentially you get 2 bites of the business relief cherry if all of this works out. There are a few issues to bear in mind. So you are putting a lot of non-qualifying assets into a trust, which means you do have 10-year anniversary and exit charges to consider on the discretionary side. And the spouse who will, after the swap, hold the potentially business relief qualifying assets will need to hold them for 2 years and will need to survive for more than 2 years from the date of the swap before the business relief is reacquired. A slight addition to that is if the will is structured so that there's essentially 2 pots or 2 sub-funds to the trust, which means that the exchange of the interests happens within the same structure, and therefore that can help you not crystallize stamp duty or stamp duty land tax or capital gains, depending on what the assets are. That's all from me.
Thanks very much. Right, Q&A. I'll just say, I thought you did well there, because you had 24 hours notice and using somebody else's slides, so thank you for that one. A quick question that's come in, a very specific one. Is BR available on shares held in a trading quoted company in India? Trading quoted company in India.
Quoted. So if it's quoted and not AIM market but full market, then no, that would be the problem.
So it might be okay if it's an AIM equivalent in India.
Yeah, if there is an AIM equivalent, and I don't know off the top of my head if there is, but
that's fair enough.
So it's an international relief in that sense. It doesn't need to be a UK company to get business relief, but it does need to be unquoted. AIM being unquoted for this purpose.
I think that's answered that question. I don't think there's any more come in. So in that case, we'll move on quickly, because I will apologise now. We will overrun because there's only 15 minutes left. I suspect we're going to be about 20, 25 minutes. So, but as I said, the invite did. I should say, if you have to leave, feel free to. I won't take offence. There will be a copy. There will be sent a recording of today's webinar with the slide back, possibly in 2 or 3 days. So if you do miss out, you can tune in and just catch the end of it then. So yeah, right. So if we quickly go on to pensions update, this is from myself and Sadiq. For those who don't know, in addition to being TSP consultant, Sadiq and I also run the firm's pensions advisory team. So we sort of do all the pensions queries for the firm. So yeah, so that's part of why we're doing this one. So this is coming out of, this is a follow-up. Next slide, please. This is a follow-up for one that we did before. We ran a session in February. The recording's available on YouTube. It's a hidden part of YouTube. It's on our channel. If when you get this time's recording, if you want to see that, you click on this time's link. I think you go to our channel and you should be able to find the February recording that way. It's probably useful. Those are the subject we covered last time. Today we're covering international aspects, tax relief for employers and unauthorized payments. And we're basically going to swap between Sadiq and I as we go through. So next slide, please. And next slide again. Right, this is me. So I'm going to be quick because we haven't got a lot of time. But the basis of this is that we've had a lot of questions over the course of the last year around can a non-resident individual, someone who's just going overseas or gone overseas, continue to paying into the UK pension scheme? And the fundamental answer is probably, but do they really want to? So we're going to go through. So this page is looking at the technical position. The legislation is quite concise. The legislation basically says in order to get tax relief, you have to be a relevant UK individual. Yeah, and an irrelevant UK individual is defined as either a UK resident or any of these 3 points here. So they have net relevant earnings. They've been a UK resident within the last 5 years, so they're not a long-term non-resident, and they were a member of the scheme before they left, or they or their spouse were a Crown employee. I have to say I've not seen that last point. So in effect, we often get this question from, where the PCS private clients team tend to get these questions from partners in partnership who may go overseas and carry on receiving their share from the UK firm. They would get it under this top bullet, but actually those people who leave the UK and aren't, and for any other reason would get it under the second bullet. However, the question is how much relief? If they have net relevant earnings, then what tends to happen is that determines the maximum amount you can pay in. But if they don't, then you are subject to the 3,600 cap. So in principle, what happens is those people who remain, who continue to get UK earnings, can pay up to that amount and get tax relief. Those who do not are capped at 3,600. That's what tends to happen. Right, next slide, please. Right, now let's deal with the but. So we said that in lots of cases they can, but if we think about the nature of the people who are asking the question, it tends to be those people who are only going overseas temporarily. They're not going. The people who go overseas long term tend to look at pensions overseas instead. So what we have here is, so if we think about that as those sorts of people, the first point is, if they're overseas, the overseas jurisdiction is unlikely to give relief for payments into a UK tax scheme. So even if they get UK tax relief, they're not necessarily going to get it locally. That's going to depend on the local rules, but as a rule of thumb, it's unlikely. So is it worth doing? The other thing is that a lot of pension schemes in practice, UK pension schemes in practice, simply won't take contributions in respect of non-residents. So it is a case you've got to talk to the administrator and make sure they're happy and things like that. And then there's this other point for employees. If you think about the way that net pay schemes work, if someone is wholly overseas and they're not actually being taxed, subject to tax on their employment income, then how can they get relief at source under the net pay scheme, which is the only way you can get relief? So there's some things there about what type of pension it is. So there's some things about you might not want to. Going the other side, you've got to bear in mind that whilst you're overseas, as long as you've got a UK pension, you continue to accrue your annual allowances. So when you come back, you might have 3 or 4, you might have be able to bring forward 3 years of unused annual allowances for the period you're away, and that in itself means that when we talk to our clients about that, they quite often say, "Oh, in that case, I'll just wait until I get back and I'll pay them 120,000 when I'm no longer subject to overseas tax. I'll get the full tax relief in the UK." And I did have one case where we had a partner who was earning about $500,000 a year in one of the big law firms, and he was going overseas. Because he was earning so much, his annual allowance was down to $4,000 a year. It was tapered right down. But whilst he was overseas, he was still getting a share of the UK profits, but only a smaller proportion. So he was only getting about 200,000, which meant while he was away, he was actually getting, his annual allowance was accruing at 40,000 a year. So when he came back, he then could put in 100. He was really happy. He could put in 124,000 in his first year back. So he was really happy on that one. This last bullet point in the middle one is a bit of an odd one. You may not be aware of. The lifetime allowance, which we did discuss at the last session, which caps the amount you can pay, you can take out of a pension in or without a charge. This can actually be increased in certain circumstances for expats who go overseas to work. So you just need to be aware that if you're working for someone who's on secondment overseas, there might be an ability to increase their LTA. Now that is I don't come across it very often, but certainly our expat team do a lot. So if you start looking at those sort of things, it's worth bearing in mind that with someone going overseas, just give us a quick chat and we can talk it through in a bit more detail. Next slide, please. All right, I think I'm going to pass over to Sleek now.
Thanks, Chris, and good afternoon, everyone. If you go on to the next slide. So here is a list of the different types of overseas pensions. It is really important to know what type of overseas pension scheme you are dealing with, because it affects how the income is taxed out the scheme and whether contributions into the scheme by the members can actually get income tax relief, or whether it affects the annual allowance or lifetime allowance of a member. So these are the most common types of schemes. A registered overseas pension scheme is just an overseas pension scheme registered with HMRC. It's basically treated the same way as a UK registered scheme. A QROPS, you may have heard from our previous presentation with Concilio. These schemes are quite commonly seen where there's a transfer from a UK scheme to an overseas scheme, and it's usually done because of lifetime allowance charge planning. There's subtle differences between each of these schemes, so it's important to read the members' pension scheme documents and then classify the scheme. A QNOPS is important for IHT because it's outside the scope of IHT. So that's just an overview. The details are with the devil's in the detail, so just to make you aware. So if you go on the next slide. So contributions to the scheme, as mentioned, certain contributions can be reliable. So contributions to recognise overseas pension schemes are reliable. A quick way to check whether the overseas scheme is a ROP is by checking HMRC's manuals. There's a list of ROPs in their manuals. And of course, in order for a non-UK resident to get a UK income tax relief, the non-resident must first have UK relevant earnings. Chris will speak more about that, or did speak more about that in our previous webinar. It's also important to remember that employers can get tax relief for contributions made to ROPs. Chris will talk more about that later. Another couple of ways for contributions to be reliable is for double tax reliefs to be available, and something called migrant members relief. So this applies where a member was non-resident when they first joined an overseas scheme and then migrated to the UK and continued to make contributions to the overseas scheme. So if the scheme meets certain requirements, the contributions will also be reliable. Next slide, please. So drawdowns and annuities from overseas schemes. So in the UK, under domestic law, any drawdowns and annuity income from overseas pensions are taxed as foreign income, and they're subject to the remittance basis. So we have to check the relevant double tax treaty to determine which country has taxing rights over the drawdown or annuity. It could be taxable in the country that the pension is situated in, or it could be taxable where the member is resident in, which will be the UK. That's usually the case. Most of the pension schemes Chris and I have come across, it's usually taxable in the UK. It is also important to realise that certain pensions, such as state pensions, might be taxed under a separate article. They're not always taxed under the pensions article in a DTA. Could be under the government service or other articles. We've seen that with Australian superannuations. Just a quick note here, there used to be a 10% deduction pre-2017 for annuities and drawdown income. That no longer applies, only applies in really small circumstances where it was a pre-1973 pension. Next slide, please. So then we move on to lump sums from overseas schemes. Now, usually we see this when a member is now UK resident and he worked for a long time abroad for an overseas employer, and the overseas employer was contributing to an employer's an overseas pension scheme. And now the UK resident wants to extract a lump sum from that overseas pension scheme. So the bottom line here is that these rules are very complex. The rules recently changed in 2017. What we usually go through is first we look at the double tax treaty. We see which country has taxing rights over the lump sum. If it's the UK, then we have to look at what type of overseas scheme are we dealing with. So all those categories that I mentioned in the first slide. Once we look at all the different ways the pension can be treated, it may fall within the Section 574 IHT rules, which tax foreign lump sums in the UK. The default is from 2017 is that the whole lump sum is taxable in the UK. So it will be taxable under the marginal rates of income tax of an individual. But the 2017 rules also introduced three reliefs available, 3 steps of reliefs. The step 1 relief you don't usually see. It's for disabled persons or persons that used to work in the military. Step 2 is what we see most commonly, and that is relief for foreign service. So if the member had significant amounts of foreign service working abroad for an overseas employer, that amount that he was working overseas abroad for that overseas employer would not fall under UK tax. If that amount of service is 75%, or if the last 10 years of the 20 years of service that he performed for that employer was overseas, the entire value of the lump sum pre-2017, pre-6 April 2017 would be exempt from UK income tax. So what we find is that only the post-2017 element of the lump sum is taxable. And even then, there's a separate relief. If the overseas scheme is a recognised overseas scheme, then 25% of that lump sum is also exempt from UK income tax. So what we usually find is only 75% of the growth and contribution since April 2017 is taxable at the marginal rates of income tax of an individual. This is, as you can see, this can be a complex exercise. Depending on the member's pension pot, if it's, say, more than 500 grand, if the lump sum is more than 500 grand, Chris and I usually produce a tax report which goes through these rules and then determines how much of the pension is taxable in the UK. We usually quote 8 to 10K for that report because it does take quite a lot of time. The other option is that we could go for a reduced version. We could write an email to the client. That gives less certainty, but that's usually appropriate if the lump sum is below £500,000. Next slide, please.
The aim being to give a filing position for when they file their tax return.
Exactly. Yeah.
Yeah.
Okay, back to you, Chris.
Thanks, over to you. I was going to say that last one. I said there. I don't study quite. There are lots of ways that lump sums from overseas pensions can be taxed, and there is, including anti-avoidance, including disguised remuneration and things like that. So what we do with our full-blown report is we go through everything. We look at everything and make sure that we've got reasons why we can discount everything, which is why it's complex and we have to spend quite a lot of time doing it. Right. I'm now moving off non-resident company, non-resident tax, non-resident issues, and moving on to tax relief for employers. So next slide, please. I mean, employers, not necessarily just companies, but employers are basically the way they get the tax relief is determined in the same part of legislation, Finance Act 2004, as the relief for individuals. And there's some quite fundamental bits in there. The first one is that the employer can only get relief. This is literally written, cut and pasted out of the legislation. Can get no relief whatsoever, except to the extent that it represents a contribution. So any payments in respect of a pension which are not contributions to the scheme, they simply get no relief for. Yeah. Now, I mentioned SIP Choice here. SIP Choice was a case probably about 2 years ago, where the company had contributed some property into the SIP, expecting that to be considered a contribution. But the tribunal turned around, the courts turned around and said it actually wasn't a contribution because the contribution had to be paid in cash. Now, but this I mean, the thing had been going for many years. So I mean, these days administrators simply wouldn't do that. But the problem was that they contributed the properties directly into the fund, whereas what happens nowadays is you contribute the cash, and then the pension company buys the property from you, uses that cash to buy the property from you. So there is there's a cash flow thing required now, but that shortcut no longer works. Right. It's important to understand that as far as the deductibility goes, most of the normal rules for whether or not it's deductible apply, excepting that the actual legislation says it doesn't matter if the contributions are capital in nature. So this might be the case, for example, if a company has bought another company and part of the requirements when it bought it was to top up the pension fund, that top up might be seen as capital in the accounts. It is still a contribution. You still get a deduction on day one. The point being that otherwise you'd have to bring in some rules that gave you the deduction when it was amortized choice to the accounts and all this sort of thing. So they cut through all of that by simply saying you get a deduction for the contribution, whether it's revenue or capital in nature. Right. The next point is we have to wholly and exclusively rules also continue to apply as they would for any other type of deduction. The interesting point here is that actually what is considered wholly and exclusively for pensions is you probably get it's probably a bit of a wider scope, because the revenue recognised that that defaulting on employees' pensions is such a fundamental bad thing to be doing. How many have we come across? How many press releases? How many things have been all over the news in recent years? It would be fundamental to a trade. So making good a pension, shortfall in a pension or doing something like that is going to be holding exclusively, even where the members of that scheme are not necessarily former employees of the person who was making the contribution. So I think we've used that in quite a lot of cases, not just for, but there's certainly been a lot of times that's come up in conversation with both internally and with TSB staff. It's this question of that, what is wholly and exclusive, and the fact that that is an argument you can quite often put forward too, is the reputational damage for defaulting on a pension scheme. Right, the other point on this, just the final thing, a lot of people who deal with corporate tax probably aware that if contributions over have increased significantly from one year to the next, you need to spread the payments. This sort of links into the fact that the old DB schemes used to be revalued, and actuaries would come in sort of every 3 years. So they tell the companies would often just pay in every 3 years, and top it up. So this is all to do with that type of thing. But spreading, just be aware of spreading. Next slide, please. Right. Buy-ins and buyouts. This has been a lot. I'm not sure to what relevant is to TSB clients, but we certainly get a lot of queries internally, and I think I've had one or two from TSB clients. So it's worth understanding what these terms mean. Buy-ins and buyouts. Basically, what these arise where there's an old defined benefit pension scheme, and the employers are saying, we don't like the risk. We're having to reassess the risk every 3 years, and we're having to put more money in, or whatever it is. And we just want to get rid of that risk. So what they do is they insure against it. So they approach an insurance company who looks at all of the members' rights over the future, and they'll say, right, if you want us to take on that investment risk, we want a premium of X amount. Now that premium is normally paid. That premium is normally paid by a transfer. It's by the pension fund of all of its assets, or out of the assets. If that's insufficient, the company will normally, or the employer will normally, put in a bit of extra cash, extra contributions. So that's fundamentally what we're talking about here. There's both a buy-in and buy-out is basically the employer ensuring, or the pension company, the pension fund itself, insuring against the risk of future investment. Now, in practice, that happens in two ways. A buy-in is one where having insured against the risk, the insurance company, the pension fund will continue to administer all of the members' rights. They will simply call on the insurance company to provide them the money as and when it's needed. So that's right. So a buyout is one where the insurance company not only insures against risk, but they're actually taking all the administration. So they take on the responsibility for paying the members, operating PAYE, and all of that palaver. So when a buyout happens, normally the fund is wound up shortly thereafter. Now, there are some tricky bits here, which has been the source of some concern with some clients we've spoken to. On a buy-in, the problem is often there's legal costs, and probably a few $100,000 legal costs, so quite significant fees. And quite often the employer just pays the legal costs, pays the advisor's costs themselves. The problem is they don't get a deduction for that unless it's a contribution, because it's not a contribution. So sometimes if you have advance notice, it's better to be talking to them and say, well, make sure the costs are paid for by the pension fund, and then you make a contribution to match the fees, and then that way you get the tax relief. On a buyout, sometimes you're okay because there is some legislation that allows on a winding up certain costs incurred to be deemed to be contributions, but that needs carefully looking at as well. Final point on this point is, where you are winding up a pension fund, and there are surplus funds kicking around. We did one recently where, having stripped it out, there was about £8 million left. The funds are normally done in two things. Either the employer can simply take the money back, in which case there was a one-time only 35% tax charge. It's not income, it's not subject to corporation tax. It's simply a one-off 35%, regardless what the nature of the employer is. So it is not an unauthorized payment. It is simply a payment that comes out and gets taxed 35. What often happens, though, particularly where there's unionized, heavily unionized business, is that sometimes they actually say, well, actually we'll spend some of it to increase the benefits, so they pay a slightly bigger premium to enhance the benefits to the members. So that's normally something just more to do good press than anything else. Right, next slide. I think right, back over to Sadiq for the final section.
Thanks, Chris. The final slide's on the next one. So unauthorized payments. So registered pension schemes are permitted by law to make certain payments to members. These are known as authorized members payments. So, for example, lump sum payments, annuities, and flexible drawdowns once the member is 55. Any payments to members other than authorized payments are unauthorized payments. And because they're unauthorized payments, there's penal charges. So unauthorized payments usually occur when the scheme administrator or member has done something naughty. For example, they may have accessed their benefits before they are 55. They've taken a loan from the pension, or they've transferred their pension abroad to a scheme that is overseas and not UK recognized. For example, they've transferred to a scheme which is not a QROPS, and that would be an unauthorized payments. And the member's liable, because they made an unauthorized payment, the member's liable to an unauthorized payment charge. That's at 40%, so it's quite penal. It's important to realize that that is not an income tax charge. Therefore, there's no treaty relief available, and it's got nothing to do with the marginal rates of income tax of the individual. In addition to the 40% charge, a 15% surcharge can also apply. That applies where the payment is large. It's at least a quarter of the total pension pot. And in addition, the scheme administrators can also be charged 15 to 20 to 40%. That can be foregone if the scheme administrators acted in good faith and they just relied on information that was provided by members. That's all we want to talk about for unauthorized payments. It's just something to watch out for, the penal charges.
Thank you very much. Next slide, I think, is Q&A. So
yeah, that's right.
Right. So while we're waiting to see if any questions come in, I just want to say that additional reading, we're doing a series, if those who receive Tax Insight, we're doing a series on pensions through that. And I know I've got one for this month. I'm trying to sign off on international pensions. We've also just handed in the Tax Journal a article on LTAs in conjunction with Conselio, so that hopefully will come out in the next 2 or 3 weeks. No questions come in. So if Reese would like to quickly put up the feedback form, that would be great. Next diary dates, well, hopefully, if you'd be grateful if you just fill that in. It's very short. I think there's only one question, might be more. 23rd of June is the date of our annual conference. So I'd just like to remind people of that one. And our next webinar is going to be 14th of September after the summer break. Thank you very much.